The fund management industry is often guilty of promoting the exciting side of investing, such as past performance and projected returns, whilst failing to adequately explain the significance of the most important part of any investment opportunity: costs. When it comes to investing in the capital markets, which is the market people use to trade equities and bonds, individuals often opt for a professional manager to look after their capital rather than directly managing it themselves. The reasons for doing so are explained in the video Direct Holdings, which you can find a link to below. The manager, or more commonly a management team, will charge an investor management fees for its expertise and services in the form of a percentage of the fund's value each year for doing so, and some may also charge performance fees if the fund's returns exceed a certain level in the period. There may also be initial fees, which is a percentage of the amount invested, or exit fees, which is taken as a percentage of the amount withdrawn. In addition, the fund incurs costs for marketing, accounting, audit, custody, and other activities, all of which are passed on to its investors. Funds also incur costs every time they buy and sell assets, the cost of trading. While some are much cheaper than others to trade, as a general rule, the more trading that goes on, the more it costs, and the more return the portfolio needs to generate to compensate for this. Each of these costs can seem insignificant in isolation, but cumulatively, and over the years, they all erode the returns from your portfolio. In fact, studies have shown over time that cost is the single biggest predictor of investment return. It is this logic that has led John Bogle, the founder of Vanguard, to make the claim that when it comes to investing, you get what you don't pay for. It is important to recognize that the performance of any investment can be made irrelevant if the cost of achieving it eliminates 100% of the return. If the portfolio in which the fund is invested returns X, the investor will always receive X less the costs that they pay. The higher the costs, the wider the disparity between the portfolio's return and the actual return received by the investor. This gap cannot be entirely eliminated by the investor, but you can at least narrow that gap by reducing or even eliminating unnecessary costs. The simplest way you can do this is to first find out what you're paying. If you find it difficult to get a clear answer from your investment manager, there is a likelihood that you may be paying too much. For more information about investing, please see the Bloomsbury Guide to Investing or reach out to us directly.